Well, on bonds, we've got Bhaskar Panda who weighs in. He says there is hardly any movement in yields without any fresh impetus. He expects the 10-year benchmark yield to trade in a narrow range between 7.3 to 7.35 today.
And then let's talk about a lot of stock-specific action to track today. We'll get to the top 10 segment in just a bit, but the stocks that we're looking at, HEG, CapEx announcement there, Time Technoplast, NTPC, ONGC and Oil India, all of them on our radar on the back of positive news flow. IRB Invit and a bunch of crude users, paint companies. We have Berger Paints, Asian Paints, Kansai Nerolac, Indigo Paints, all of them that are likely to open in the red.
All right, Matt Orton is Chief Market Strategist at Raymond James Investment Management. He's joining us right now with some views. Matt, great to have you back on the program. Thank you very much. The big news in a way is what's coming out of China, right? At least incrementally. You've got reopening, even as cases are rising sharply. The takeaway, I guess, from a markets and financial economy standpoint is that the reopening is firmly on track and maybe even faster than expected, incrementally, even though cases are rising. There's no U-turn, there is no roadblock, there's no rethink, at least so far. What's your sense?
Hey, good morning, Prashant. Great to see you, and thanks for having me back. And it's definitely marginally positive news with respect to what's happening in China. And it's hard to tell how far they're going to let case counts get extended without maybe making some changes. So when you look at China overall, it's definitely positive. I think it's positive for global markets overall. It's certainly been positive for the returns of emerging markets, especially relative to developed market performance over the past week. But when I look at how I want to be positioned moving forward, Chinese markets have already had such a massive run over the past 2 months or so on these reopening hopes. So I'm not sure if there's still a lot of money to be made in that trade. Certainly it can continue, but a lot of the good news is already baked in, and now we have to deal with reality. And we also have to deal with reality of global markets as well, which is largely going to be driven by what happens to the US economy moving into next year. So when I've been talking to clients over the past couple of weeks, it's really been what we've talked about in the past, which is you need to be defensive heading into next year, maintain a core defensive bias, which means lean into companies that are profitable, generating free cash flow, lean into higher quality companies. That's where I want to be. And it's even been the same case in India, consumer staples, healthcare. Those have been the sectors that have largely been outperforming over the past couple of weeks. And I think you want to lean into a lot of that globally over the next, call it 2-3 months, because being defensive is going to work. There's just so much uncertainty with respect to how the economic narrative coincides with inflation finally peaking and what the Federal Reserve is ultimately going to do.
Okay, Matt, hi, good morning, and greetings of the season to you. Good to see you in office attire in the last week of 2022. Misery loves company, as they say. But no, jokes apart, how are you feeling about 2023? Do you think that this is going to be a year where emerging markets outperform developed markets? And in that context, how do you see India?
Yes, so yeah, I think emerging markets can outperform, and we've already been seeing that take place over the past couple of weeks. It's encouraging. Emerging markets for such a long time have just underperformed the U.S. They've underperformed global markets. Valuations are very, very cheap, and we're finally starting to see that turn because there's a number of emerging markets that have more idiosyncratic drivers. They're not necessarily tied to what happens in the US economy, or they have more independence on the energy front, or they're tied to global reopening. They're tied to the Chinese reopening without being dependent on government policies and regulations, which is a risk in China. So India is a great example of that. It's been a star performer in 2022. It's been one of my top country picks. I still like it heading into 2023, even though there's been a little bit of weakness, which frankly I think is good. We're having a little bit of consolidation. Key levels have been holding up. And I think there's still a lot of areas of opportunity. I think information technology in particular, some of the consultancies that benefit from offshoring, and I'd say kind of margin preservation from companies over in the US and Europe, I think that can continue. I think industrials can also do well in India, and financials. as well. I've liked financials for a while, and I think we're starting to see banks, the possibility for net interest margin expansion. So I'm definitely optimistic on India, but I also like certain Latin American countries too, because they've been well ahead of the rate rising curve with respect to the Federal Reserve. So you've got Brazil that's been well ahead of the curve, but also countries like Colombia that have a very, very dynamic financial system. Banks there have been outperforming. They're a little bit less tied to what's happening around the rest of the world with good exports. So I think there's definitely a lot of opportunities, but the key in emerging markets is being selective in what you own, because there's a lot of countries that still have economic challenges that will be impacted by the stronger dollar, even though it's a little bit weaker. So you need to be very, very selective.
But you said that, China has run up in the last couple of months and offers little on the way upside. And while you are positive on India, you're also positive on other emerging markets. Just wanted to understand what your pecking order, the incremental dollar that you deploy in emerging markets, how would that be shared? Because India is not particularly cheap either.
No, it's not particularly cheap, but I mean, on a forward PE basis, the Nifty's still back to around pre-COVID levels. So it's definitely compressed a lot from where we were at the top. And just because something's expensive doesn't mean it's not going to perform well going forward. And I think 2022 has been a great lesson in that. A lot of the more defensive sectors have been more expensive, but have continued to work. So when I look at emerging markets overall, I want countries that are more independent from the global slowdown narrative. So India definitely ranks up towards the top of that list. I think after India, I really like certain Asian countries that have exposure to China, but that aren't tied to China exclusively from an export point of view. So South Korea is interesting. Vietnam, Thailand are a little bit more interesting, as is Indonesia. So I like kind of the Southeast Asian complex because of China exposure. So you get the ability to profit from the reopening, but you're not tied to regulatory headwinds. And then I'd say Latin America, Brazil, Colombia, and Mexico, those are kind of in the third tier of countries that I like within the complex.
Matt, I just wanted to put one opinion up, and this is about the kind of names which will do well. This is coming in from Daniel Loeb, who runs Third Point, which is, a well-respected, large $15-16 billion hedge fund in the U.S., this was a tweet he put out yesterday. He says, and I quote, "I tend to be more of a bottom-up analyst, but 2023 should prove to be a year of a battle of two narratives, rates and inflation on one hand versus GDP growth, margins and ultimately earnings on the other. Markets will be further determined by participants' outlook from current company performance versus 2024 and beyond. I don't think camping out in the last decade's darlings with rosaries in hand, hoping for a comeback, will be the winning strategy. We have seen the revenge of the value nerds. I think more is to come." So value is what Daniel Loeb seems to think will do much better, and not growth, which is, the traditional cyclical old economy kind of names, not necessarily, but mostly, and not tech and new age, etc. Would you agree with that?
I absolutely agree with that. And I think that fits in perfectly with this more defensive narrative, because a lot of the more value-oriented companies are defensive. And I'll break that down even a little bit further, that it's valuation that's mattered in 2022, and that's going to continue to matter into 2023, because there's a certain point at which investors are just not going to be willing to pay for the future cash flows that may or may not exist. And that's why growth has gone through such a painful correction this year, because there's been a lot of companies with management teams that have never been through an environment where interest rates were greater than 0%. They've never had to navigate the challenges of discounting future cash flows and thinking about earnings and profitability. So there's still a lot of losers that are going to need to be shaken out. I think that leaves the potential for a lot of interesting acquisitions. Moving into 2023, you're seeing private equity companies still fairly active, but as I look into 2023, it's that clash of that economic narrative, along with peak inflation, that's going to keep volatility elevated for at least the first half of the year. And it's why I'm so adamant on being defensive with respect to your positioning and focusing on company-specific fundamentals, because it mattered in 2022, and it's going to matter even more in 2023. And similarly for emerging markets as well, it's knowing the specific countries you own, what the catalysts are that's going to move them going forward. And that's how you're going to outperform next year, I think.
Okay, well, on that note, we will let you go, Matt. Always a pleasure speaking to you, and have a great 2023 if we don't chat again very soon. Any plans to travel in the next couple of days?
I think I've been visiting family for the past week, and so I'm going to go warm up back in Florida where we're based at the end of this week. So all the best to a Happy New Year to you as well.
Well, you live in a holiday destination, so you don't need to go anywhere else. Have a great 2023, Matt. Thanks a lot for joining in. Thanks for joining in. Okay, well, that's the word coming in on the markets. Emerging markets could outperform developed markets, and they continue to like markets like India. Let's slip into a quick break. Our list of top stocks coming up in just minutes from now.